Hi everybody, and welcome to this advanced training course. And in today's course we're going to be talking about volatility, and probably one of the most important aspects of trading that retail investors tend to ignore, or they don't understand, or both. And we're going to go through some heavy material here. There's some numbers that we're going to be calculating. There's some formulas that we're going to be using. But for the most part, I'm going to try to make it really simple and try to use try to put it into terms that are actionable for you so that you can make your trading a little bit more interesting, a little bit, you have a better handle on why the market moves and how the market moves and that kind of thing. So it's going to be, I think, very, very interesting. I find volatility to be one of the most interesting parts of trading, because it really does give you an upper hand over all of the other traders. Any trader who ignores volatility is doing so at their own risk. There's a lot of information available about volatility, and I'm going to talk to you and discuss with you a few of the different types of volatility there are, as well as showing you how I use the VIX and a formula I use the VIX to help not predict trends, but to kind of give you an idea, kind of give you a hint of how volatility does affect the trends of the market. So, and it also helps kind of to predict in some ways what will happen in the market in the future. Anyway, let's get into it. I'm going to share with you what I know about volatility. I'm not going to hold anything back. This is kind of like my secret sauce for trading in the markets, to kind of giving me an upper hand in what I expect the market to do on a daily basis and over the near term. And we're also going to be talking a little bit about how you can use the VIX and volatility to help your trading. Very, very important. All right, let's go into volatility itself. There are three measures of volatility. There's historic volatility, there's the VIX, which is the CBOE Volatility Index, and then there's implied volatility. Historic volatility is simply the history of volatility over the history of a financial instrument over time, measured by standard deviation. I'm not going to get into a lot of the details, but you can look it up on your own. But basically, it's exactly what it says. It's historic volatility. So if you look back in time over the period of a given stock over 6 months, a year, 2 years, 5 years, 10 years, you'll be able to see the historic volatility, how often that stock either goes above the standard deviation or below the standard deviation to determine exactly what the volatility of that stock is. So more volatile stocks will be generally trading in ranges that are above the standard deviation, and those that have not as much volatility will be trading at the standard deviation or below. The CBOE Volatility Index is a key measure of the market expectations, near-term volatility, and investor sentiment based on the S&P 500. Now, what's interesting about the CBOE Volatility Index, or the VIX, is the formula used to calculate it, and we're going to come back to that in a second. Let's talk about implied volatility. Implied volatility is the estimated volatility of a security price, and it increases when the market is bearish, and it decreases when the market is bullish. And it's used to calculate option premiums. This is a forward-looking volatility. The implied volatility is forward-looking. Historic volatility is backward-looking. And the CBOE Volatility Index, or the VIX, calculates near-term volatility and sentiment. It does include investor sentiment in its definition, and that's kind of an important thing to take note of as we go forward. And it's based only on the S&P 500. So the implied volatility can be on a stock, it could be on an index. Historic volatility could be on a stock or an index as well. But the implied volatility is what's used to calculate options premiums for that particular stock or ETF. Now, let's take a look at CBOE Volatility Index for a second, because it's the one that most people have come to, regard as the key measurement, the key index for determining investor sentiment. But what does that really mean? Well, it only becomes clear when you figure out exactly how the VIX is calculated. And so the VIX is calculated, and I quote here, is it using a formula to derive expected volatility by averaging the weighted prices of out-of-the-money puts and calls using options that expire 16 and 44 days respectively. Now, what that means is that they are taking a sample of, they're looking at the S&P 500 stocks, and they're basically looking at the prices of those out-of-the-money puts and calls. Now, what happens when a put or a call rises in price? Well, generally, it means that investors are bidding them up for some reason. So, for example, if you have a stock that investors, and this is where the investor sentiment comes in, they feel that the stock is, maybe it'll miss their earnings projection. So if an earnings announcement is coming out and they feel that they're going to miss their mark on earnings and the stock is going to tank, then they'll probably bid up puts in that particular stock. And when they bid up the puts, if the stock is in the S&P 500, it's going to have an effect on the VIX. And that's why you can look at the S&P 500 price index and get a good idea of the trend of the S&P 500. But when the volatility index, the VIX, begins to rise, then you know that out-of-the-money puts and calls tend to are also rising. And so you can see that, let's say there's a dozen or 2 dozen stocks in the S&P 500 that investors are expecting to miss their earnings estimates, then they're going to start bidding up those puts. Now, and a lot of times what will happen is, and a lot of investors will do this, will also affect the calls as well, because they'll bid up the calls and the puts, and they're doing straddles or something like that. So what happens is that you can get it's really an early detection system. If you think of the VIX spread across, measuring the prices of the out-of-money puts and calls on the S&P 500 across all of those 500 stocks, and they're weighing those, and they're saying, okay, these stocks are going to be bid up, or these stocks are being bid up, these out-of-the-money puts and calls. Now, you notice that they're only using out-of-the-money puts and calls. So what they're saying with out-of-the-money puts and calls is they're saying that in order for investors to profit from those, they're expecting a big move to come, because if you buy an out-of-the-money put, you buy an out-of-the-money call, especially using those options that expire in 16 and 44 days, those are relatively close month option contracts. They expect a move to come very, very soon. So they're using out-of-the-money puts and calls, they're bidding those up, they're using short-term expiration dates, and so they expect a move to happen very, very soon. And that's the power of the VIX, because it gives you an idea of what might happen based on investor sentiment by putting their money on the line, by bidding up puts and calls on the S&P 500. Very interesting stuff. And so what happens is, really, one small change in volatility can have a huge effect on the market, because let's say a very important stock is it misses its earnings estimates and it really starts to dive. Well, it can send ripples throughout that industry. So other stocks in the S&P 500 are in the same industry. Can now be maybe a lot of investors feel that industry is now not as good as it was. Maybe earnings across the board are going to be cutting estimates, and those stocks will eventually decline in value because of that one stock that missed their estimates. And if that's the case, then there could be, especially with large traders and those who manage mutual funds, could start to sell that industry across the board. And normally they have a basket of stocks in that industry, especially mutual funds. They're holding a wide variety of stocks. And if they feel that the prospects for that industry are no longer positive, they could start liquidating those stocks, and it could affect the entire industry. In fact, it could affect the entire market. So the VIX can give us clues to potential market moves and trends, and we can look at the VIX using a single indicator and tell if changes in the trend are coming before they happen. And we'll get into that in just a few minutes. What it does, like I said, is that it does one small change in volatility can have a huge effect on the market. Let's take a look at this for a second, because the VIX is really like a seismograph for movements in the S&P 500, because it can measure the underlying trends in the S&P 500, the stuff that you can't see in the index, the price index itself. The price index of the S&P 500 just reflects the price. That's it. It doesn't tell you individually what the stocks in the S&P 500 are doing. You'd have to go through all the S&P 500 stocks in order to make that determination. But what the VIX does, it allows us to see ripples in the market. It helps us to see early on what's happening in the market. And so this is the graph above is an actual seismograph. It's the earthquake meter, if you will. It'll tell you exactly what happens during, before, and after an earthquake. And so P waves are the little rumblings before the actual earthquake comes, and early detection units can pick those up and kind of warn people, a little bit ahead of time. They do come very, very fast. And then S waves come a little bit, and you can see they're a little bit bigger. And then all of a sudden, surface waves come, and they bring and produce the largest disturbance on the seismogram. And then of course, later on, they start to subside and they go back to normal. Well, this is the VIX going all the way back to 2004, 2005. And we can kind of see the same or similar kind of ripples happen throughout the market. We have the P waves. It gives us an early indication that something is happening here. Volatility starts to increase. Now, what happened during this time period? Well, during this time period, probably a few stocks started missing their estimates. Stocks started to sell off, and so the VIX gave us an early warning. It didn't hit the entire S&P 500 yet, but it gave us an early warning that something was going on underneath the surface. A few of the stocks in the S&P 500, their puts or calls were being bid up sharply, and that creates volatility. And so when investor sentiment, when investors are expecting that that a stock is going to miss their estimate and they're bidding up those puts, it's going to be reflected in the VIX. That's very important. When those option premiums start to change, they start to get bid up, it is reflected in the VIX. And then, as you can see, it subsided a little bit, and then all of a sudden we started to get some larger waves here in the VIX. This is the VIX. This is the volatility index on the S&P 500. So the S wave started to come. You could tell it, volatility was increasing even more. So we got a little bit of a hint here. We got more of a hint here that even more S&P 500 stocks were starting to get bid up. The near-term options were getting bid up that were out of the money. So investors were expecting something to happen very, very soon in the market. And then all of a sudden, of course, we got the surface wave. We've got the huge wave up that was the crash in 2008, 2009. And then we started to see that happen from, this is approximately 2007, 2008, 2009. And then as 2009 started to subside, then we started to get less and less volatility. So those ripples in the market were subsiding now, and all of a sudden we're getting back into some sort of lower volatility environment. But very similar to a seismograph, it would tell you early on whether or not there is in fact something else coming. And that's exactly what happened during the 2008-2009 crash. So let's take a look at volatility a little bit more. Here's the VIX, the volatility index for this time period. And I'm going to pick out, there's a couple different time periods that I think are really, really interesting. But I'm going to pick out this one in particular. It's very similar to these other ones that I've identified. But what happened during this time period? What I'm going to do is take a look at the average true range on a 14-period basis for the VIX. Okay, so what I'm really doing is measuring the average true range, measures the range of the bars on the volatility index, on the VIX, to give me an idea of whether or not it's high or low. Basically, if there's a huge range on the daily volatility index as it's being measured in the market through the S&P 500 out of the money puts and calls, then it's going to show up in the volatility index. And you can see during this time period that the volatility index went from a range of about 10% to about 13% here. And so it's not a whole lot of range movement there, but it did go up and down. Basically, it was just flat. I mean, it was just basically just between 10 and 13%, which is a fairly small reading on the volatility index, on the VIX. But there were up and down movements within this time period, right? And with the net effect of just kind of going sideways. And what the average true range, which I like to use as a measurement of the VIX, is really if you can look at the average true range as the volatility of the volatility. It's the volatility of the VIX. And so during this period, as you can see, the average true range, in other words, the volatility of the VIX, was relatively flat. And so what did that mean to stocks? What happened to stocks during this particular time period? When you're basically in a flat line, non-movement, it means that the range of these bars in the VIX were very, very small, and that's what the average true range actually measures. It measures the range of the bars on a daily basis in the VIX. Well, if you've taken my course, The Winning Trade System, you knew that one of the measurements that I looked at, one of the things that I looked at very closely was the range of the bars on stocks, on the indexes as they move. And if I saw wide-ranging bars starting to enter the picture, then I knew that volatility was starting to pick up in that. Without even looking at the VIX, I could tell simply by price movement that there was something going on in the market that would probably either send it lower if we started to get a large range of movement in the price indexes, or if we started to get smaller bars, smaller daily ranges of movement in the S&P 500 and the Dow, then we'd probably see lower volatility and the market will rise. So what happened during this time period? So if we take a look at this particular period, we can see that just after this period, volatility increased a little bit, not a lot, but a little bit. And if we take a look at the S&P 500 during this time period, you can see that even though this is flatline, it showed that there was low volatility in the VIX itself. The market actually rose 71 points. It rose from approximately 1921 level up to the 1992 level for this very same time period. And then, as you can see, right afterwards, volatility increased and it declined significantly from the 1992 level all the way back down to almost 1900. So let's take a look at this again. If we have low volatility during this time period, but we can see something is going on here, then we start to see a spike right here. We get a spike, and what that spike represents is the range of the S&P, or the volatility index itself, a range of the bar of the VIX. And so what we're looking at is the underlying, the hidden volatility, the volatility that you really need to pay attention to, which is the volatility of the VIX itself. And when that starts to rise, then you get a clue that, in fact, the market probably is going to sell off. And that's exactly what happened. We got a sharp rise in volatility right on this bar here, which is uncharacteristic for that time period. Because the volatility of the VIX is relatively smooth, we got a sharp one there, and then the market sold off dramatically, which brought us up to this point here, which showed that, in fact, volatility rose very, very sharply. But it gave us a clue before that happened, and so we could predict ahead of time whether or not the market was going to decline. And now, when it got to this point here on this same chart, that is this period here, and we saw volatility once again start to decline significantly, and we started the new downtrend. And it's relatively even cycles. There's cycles where the volatility index becomes volatile, and then there's periods where it eases off and it doesn't become as volatile. It's always trying to find some sort of a level. When it's too low, there's too much complacency in the market. There's really a complacency on the part of investors that that stocks will continue to go higher. And so what the volatility index does is measure basically not only the risk that's in the market, but also investor sentiment, as we've seen. And so we can use both the level of the VIX as well as the volatility of the VIX itself to help predict future price movements. So what are our takeaways here? The VIX tells us what is the probability of range of movement of the S&P 500, and the S&P 500 will likely experience on a daily and annual basis. And there's two formulas that we can use in order to determine both the estimated daily range and the estimated annual range of the S&P 500. The estimated daily range is the VIX divided by 44 times the S&P 500 price, and that gives us the estimated daily range. We used 44 here because that's the option cycle that the calculation is based on. They use options that expire in 16 and 44 days. 44 days is the longest, so that's the one that we use in the calculation. And then on the annual, to estimate the annual range of the S&P 500, we can take the current VIX times the S&P 500 price. And we also use the average true range of the VIX to help trend identification, which is the volatility of the VIX. I know that sounds kind of strange, but actually it is a tremendously helpful tool in order to determine what is going to happen in the future. So for example, if we see that we've got some bouncing around here on the volatility index, but the actual range, the actual volatility of that index is relatively low, then we know the environment is set up for the S&P 500 to increase in price, because volatility is normally low when the S&P 500 rises, and it generally increases, the VIX increases in price when prices fall. And so it gives us some predictive value in that when the actual range of the bars of the VIX is small in relation to its historic volatility. In this case, using the average true range, we can tell that the average volatility in this case was relatively low, and it gave us a flat line on this reading. And it gave us a good indication that the market, in fact, was going to rise. All right, let's take a look at these particular formulas here, and let's do a couple of examples of these formulas. We're going to start with the annual range. Now, the VIX represents a percentage. Actually, when you hear the VIX is at 12.85, what it actually means is that volatility is at 12.85%. It's at 12%. If you hear the VIX is at 40, that means the VIX is at 40% volatility. And so what we need to do is take the VIX as a percentage, it is a percentage, 12.85%, and convert it to a decimal. And the way to do that is simply to take 12.85, divide it by 100, and you get the decimal. And we need that decimal in order to make our calculations. So 12.85 is equal to 0.1285. We take 0.1285 times the current price of the S&P 500. It's right around the 2,000. I just used 2,000 to make it simple here, but the price of the S&P 500 is at 2,000 times 0.1285. It gives us 257 points of range. And so from this point, so the predicted annual S&P 500 range could be as low as 1743 on the low end and 2257 on the high end. And what that means is basically, let's say from today, if the S&P 500 if the VIX is at 12.85%, then the annual predicted range, if it started to decline from today, the low end could be 1743. If it started to rise from today, it could be 2257, or it could be anywhere in between. It could go down 130 points. Let's say it goes down to 1850, and then it goes up to 2150. It could do that as well. That's a 257 point range. However, if it started to drop from today, you could expect the lower end of that range to be 1743. If it started rising today, the high of that range could be 2257 within the next 12 months. And a lot of the calculations, a lot of the pundits on TV who talk about and discuss, many times they'll ask them, well, what do you think where the S&P 500 is going to be in a year? Where's it going to be in a year? Well, this is what they generally say. They're going to, if they feel if they feel bullish on the S&P 500, they're going to say, well, I think it's going to be around 2250. They can give those kind of predictions because they're basically using this formula. Let's take a look at the S&P 500 estimated daily range. So you can actually take this calculation for every single day in the market. You take a look at what the volatility index was the previous day. If it was 12.85, that's 12.85%. Converted to a decimal is 1285, 0.1285 divided by 44. Remember, 44 is the options expiration that we're using. Option expiration that we're using in 44 days was the longest period of time that they use in the calculation of the VIX. And then we divide that by, we take 0.1285 divided by 44, gives us 0.00292, and we multiply that by the current price of the S&P 500. And so we get a range of 5.84. 5.84 is the expected daily S&P range. So what we would look at, this would be considered to be the fair value of the S&P 500 for this particular day's trading range. And so it could be as low as 1994.86, which is just 5.84 minus 2000, which is the current price of the S&P 500, to give us a low end of the range at 1994.16, and at the high end 2005.84. So obviously that's why this range is wider than the 5.84. It's actually double that. But because the market, if it does start to decline immediately from the open, you would expect that the low of the day would be 1994.16. And a lot of traders who do day trading, who trade the S&P 500 on a daily basis, will use these numbers as targets. So for example, if we traded down to 1994.16, they would go long at that point because they know that the daily range, the expected price of the S&P 500, and the range of the S&P 500 is going to be about 6 points. So they would look for other signals as well, but they would have at least a target, a number that they would use in order to determine when to go long the market. If they know that's what the range is, they would think that they would consider this to be the bottom of the market, and the market could rise at that point. Or if it got up to 2005 and 80.84, they would be looking at that point to go short the market with, in addition to other signals that they would be using and other technical factors to look at that as a potential target to short the market because it's hit the expected range. So all of these calculations are really, really interesting. Here, for example, let's take a look at the VIX if the VIX is at 32%. So if it's at 32.85%, we would do the calculations for an average daily range. We would expect the market to move about 15 points a day in that particular day, in that particular daily range. And so now we'd have a range of 1985 to 2014, and so depending on the level of the VIX, what the current VIX is trading at, using this calculation would give you the expected range of the S&P 500. So you would expect the S&P 500 to move 15 points in a day, based on a 32 VIX. Okay, so that's why it's very, very helpful to understand what the VIX is, what the volatility index is, and how to use it in actionable terms to help you with your trading. So this not only helps you with your trading, but it also helps us when we're determining when to put on three-legged spreads. So let's go back to this example for a second, because when we look at the VIX in this time period, we would say, okay, it looks like volatility is low. We would expect the market to go higher. And so unless something changes in this particular scenario, we would do very, very well to go long the market when volatility is at these levels and the volatility of the VIX is also relatively low. And so we would be looking at going long this period. We would also look at establishing additional long positions after the market has had a pullback, and why we have some confidence during the pullback that in fact the volatility of the VIX is starting to decline when we see it starting to roll over here. When we start to see the VIX starting to roll over, at this point we can tell that in fact the market is ready to advance again, and this is when we go long the three-legged box spreads. So this is how I use volatility to determine when to go and when to use either a long or a short three-legged box spread. It's not price alone. It's not technical analysis of prices that gives us a signal when we should go long or short a three-legged box spread. Instead, it's the volatility of the VIX that gives us that clue. Because when volatility of the VIX starts to increase dramatically, we know that there is in fact the opportunity for the market to decline significantly, but we also know that when that volatility subsides and we start to decline in volatility on the VIX index itself, the market will also rise. And so we use this particular average true range of the VIX itself in order to help us determine when we should put on both a long three-legged box spread and when we should put on a short three-legged box spread, because it will tell us if the volatility of the VIX is low, relatively low. It doesn't matter if it goes within a certain range or not. This went between 10% and 13%, which is still a relatively low reading on the VIX, that in fact the market will probably and most likely advance. So it's not technical analysis on stocks or the market or the ETFs that is going to give us a signal to enter a three-legged box spread. It is in fact volatility telling us when we should enter those trades. Anyway, I hope this was clear. If there's anything that you don't understand about this, please ask questions in the comment section below. Also, you can go over this video many times. You can replay it as many times as you want in order to fully understand what we're trying to do here. But I can't emphasize enough how important this concept is. We're really measuring the volatility of the VIX. Yeah, and I know it sounds strange, but it's the volatility of the volatility index. And it gives us a clue as to whether or not the market is going to advance or decline. For example, during this period here, the VIX actually rose pretty significantly from about 12% up to 16.5%, which is a slight sell-off. But you can tell during this time period, the actual volatility of the VIX rarely moved, and we had a strong rally during that time. Here's another one. The volatility was up to the 19%, and it's a relatively high level. However, we have a relatively low volatility of the VIX, and the market also rose during that time. All right, guys, I hope that's helpful for volatility, understanding volatility a little bit better, and how to use it as an actionable tool in your trading. All right, guys, I'll see you in the next session.